FRM Part 1, Book 1, Foundation of Risk Management, Topic 9, Learning from Financial Disasters. And if we have a look at this particular topic, Topic 9, in my 2 cents worth, okay, I would rate this as probably your second most important topic out of Book 1 after Topic 5, of course, which was the CAPM and the MPT, Modern Portfolio Management and CAPM. I would rate that as your most important topic, Topic 5, and Topic 9 coming second. Very, very likely to get 3, possibly even 4 questions coming out of Topic 9, learning from financial disasters. Those that have seen FRM Part 1 before, obviously, as you guys all know, this is the 2020 syllabus, and of course the 2020 syllabus has been updated for changes, etc. One of the key areas that were changed, particularly in Book 1, was of course this topic 9. Quite a few changes coming into Topic 9, so those that have seen it before, unfortunately you can't relax with this particular topic because there is some new stuff coming out. And what they've done particularly, they've kind of like put everything into one big learning outcome 9A. Okay, and they break down all the financial disasters that are going to be contained in this particular topic. They break them all down into the various risks and areas that the particular disaster occurred in. For example, they look over here, there's interest rate risk. We'll be focusing on funding liquidity risk, okay, hedging, model risk, things like that, okay, rogue trading, misleading reporting, okay, financial engineering, complex derivatives, reputational risk, corporate governance, and cyber. So what we're going to do is we're going to take this particular topic and we're going to break it down into several of the specific risks and each company that that particular disaster occurred within that particular risk. Okay, let us jump straight in and let us get ourselves going. Okay, there we go. Let's jump straight down. Okay, first risk we're going to be focusing on, interest rate risk. Okay, the first one that occurred in, okay, was the savings and loans crisis. Okay, just before we start, we ask the question, of course, the obvious question: what is interest rate risk? Okay, a simple form of interest rate risk, okay, is, as we know, okay, we haven't seen too much of it yet, mainly in Book 4. Okay. We'll see more about fixed income securities, okay, but we know, okay, when interest rates rise, okay, as interest rates rise, the value of fixed income securities fall, and vice versa. When interest rates fall, the value of fixed income securities, they rise. Okay, that's a simple form of interest rate risk. Curve risk, okay, is, for example, you've got fixed income securities that are hedged against parallel movements in the curve, but not against the change in the shape. Now, what does that mean? And I don't want to spend too much time on detail over here, but if we just have a brief look over here, okay, and I just have a quick look at the curve, okay, and let us draw ourselves a little interest rate curve over there. Now, if you have a look over here, okay, here are the various maturities. Okay, you've got, I don't know what, you've got 1 month, 2 months, okay, 6 months, 12 months, a year, etc., etc. Okay, now a parallel shift in the interest rate curve would look like this. In other words, when interest rates move, let's say, for example, for the 1 month, moves exactly the same amount for the second month, moves exactly the same amount for the 6 month fixed income security, same for the 12 month, and same for the 1 year, etc., etc. Okay, if the shift in the curve, I'm going to just change color over here, let's go to red. If the shift in the curve wasn't parallel, but it was a change in shape, so for example, it might look something like that. And what you can see over here, that for the 1 month, it was a little bit of a change in the interest rates. Okay, sorry guys, just to make it clearer. Of course, rates, the interest rates are up there, and the term is on that axis. Much bigger impact for the 12 month period, smaller for the 2-month period, and as you can see, it's a non-parallel shift in the curve. Okay, and the last little risk that we're going to focus on over here, okay, is basis risk. Okay, that even when a hedge has been taken out, the hedge is obviously what we know is something that is used to protect the value of an asset. Okay, to protect to cover a future liability. Okay, if the particular hedge is not a perfect hedge, in other words, the hedge and the asset are not perfectly correlated with each other, we would have what we call basis risk. Okay, and of course then we can expect some losses to come through there as well. Okay, good. One of the ways to manage interest rate risk, okay, is for a firm to manage their balance sheet. In other words, that remember, if we just have to have a quick look over here before we carry on, if you look at a stock standard, a bank, and you say, well, what does their balance sheet look like? Well, a bank has got the two sides of their balance sheet. Okay, you've got assets. Let's put the assets that side, and the liabilities that side. Now, the assets to a bank are when they give out loans to people, and the liabilities are the deposits. People deposit money at a bank, and obviously they expect that money back. That's a liability to the bank, but of course the deposit is an asset to the depositor. One of the ways to manage the risk, okay, interest rate risk, okay, is to try and match these up. In other words, so yes, there may be a change in rates that will affect the loans, but let's try and make sure it's got the same impact then on the deposits. The overall effect will be quite neutral. That'll only, of course, happen if your loans and your deposits, or your assets and liabilities, are highly correlated with each other. Okay, there are ways to do that. We're not speaking about it too much now. We're going to wait for the VRM book, which is book 4, Valuations and Risk Management. That's going to be book 4, where we deal much more extensively with fixed income securities. Needless just to be short over here, just to try and explain what's happening over here. How do we try and match up our loans and deposits, our assets and liabilities? We use a thing called duration matching, as well as the use of derivative instruments will help us as well. Okay, now let's have a look at the specific case called the savings and loan crisis. Okay, during the early part of and in fact the major part of the 20th century, the savings and loan industry was doing fantastically well. Okay, in part there was two reasons for this. Number one, an upward sloping yield curve. Okay, and what does an upward sloping yield curve do for us? Now again, let's have a quick look, make sure we get a full understanding of this. If I draw you an upward sloping yield curve over here, remember, there's the curve, it's going upward sloping. In other words, what does that mean? We're going to put your interest rate is over there and your maturity is over there. In other words, as the maturity of the particular instruments increases, so too does the interest rate go up. Okay, have a look over here. The rate that borrowers, okay, paid on their long-term loans was a much higher rate than what the bank was paying to the depositors. Okay, remember, in most cases, okay, if we just have a look at it going back to the bank's balance sheet over here, loans, okay, which are assets to the bank to borrowers are normally quite long-term in nature. Think about a bond or a mortgage on a house, whereas deposits, generally the funding of a bank, their liabilities is shorter term. Now, if your shorter term or your liabilities, okay, is short term, and at that short term period, let's say over there, rates are very low, as opposed to over there, the longer term, your rates are much higher, you're earning a nice little amount over there, which we call the spread between the two different rates. Okay, that is very much to the benefit of the savings and loan industry, number one. Number two, okay, let's have a look. We call this Regulation Q. It didn't allow banks to pay interest on demand deposits. So if you put money into a bank, what's a demand deposit? You can get the money back almost on call as you want it. There was no interest paid on that. So that's almost like free funding in a sense for the bank. Okay, what went wrong? Okay, during the 70s, inflation rose. Okay, the Federal Reserve, that's the central bank, the American Central Bank, increased these short-term rates, and that's obviously over here. So these short-term rates that were very cheap over here, that rate went up. Okay, and as that rate went up to almost match the rate on the deposits, okay, so on the loans, they effectively wiped out the spread for these banks. There went their profit margin. Okay, good. As a result, savings and loans looked for higher margin loans. They said, okay, well, we're not making any money anymore on these loans, the old loans. We're going to have to find other loans that can give us higher interest rates. Okay, and of course we know when you look for higher, what type of asset or what type of loan will give you a higher rate? Well, of course it's a riskier asset or a riskier loan. So they were starting to look for riskier loans, riskier business. Okay, and as they did that, of course, the system tended to unravel just a bit. Okay, the process, these new loans that they were taking out also were not well managed in terms of credit risk and business risk. Okay, and look at this, during 1986 to 95, about a 10-year period, over a third of savings and loans in the US failed or were taken over. Okay, and at that point in time, a bailout of 160 billion US dollars was needed, and that was funded by the US taxpayer. Okay, now just a little bit of guidance in terms of answering these particular questions in terms of financial disasters. Guys, they do go quite specific, and you need to know the detail behind these particular cases. Okay, don't, for example, they may say to you, what are one of the reasons? Okay, or they may give an example. They say savings and loans in the 90s failed for the most part. Which of the following, A, B, C, or D, was a major reason for the failure of savings and loans? And obviously you need to know between number 1 and number 2. Okay, good. We move to risk number 2. Okay, and this is obviously a hugely important risk, of course, because this is probably one of the key reasons behind the 2007 and 8 global financial crisis, which we call funding liquidity risk. Yeah, and just important just to know the difference between the different kinds of liquidity risks. Okay, we start off over here and we look at liquidity risk. Okay, and generally liquidity risk, when we look at it over here, okay, is what we would call market liquidity risk. And market liquidity risk is the fact that you get a reduced value of your asset when selling in the market. And the reason for that is there's not a whole batch of buyers or sellers. Generally, the liquidity in the market is quite small. Okay. And of course, one of the reasons for this first type of liquidity risk would probably be the one that we look at is you look at your bid-ask spreads, the difference between where the buyers or what the buyers are asking for the asset and what the sellers are demanding. And if that's a very wide range, for example, you got your bid over there and your ask over there, your bid is sitting at 100 and your ask is sitting at 200. Well, nothing's going on over there. Okay, they're not matching at all. Whereas if your bid is at 100 and your ask is at 101, yes, a lot of trade will go through and there will be a lot of liquidity and obviously a low level of liquidity or transaction liquidity risk. Okay, we move to the next risk, and this is the one that we're dealing with over here, which is called funding liquidity. Okay, and funding liquidity is when one party is unable to make payments to their counterparty, they just don't have the liquidity. Okay, and what are some of those? Reasons that they're unable to make payment due to liquidity? They can't refinance their debts. Okay, they're unable to make cash payments to the counterparties, or they can't fund capital withdrawals. For example, if people are withdrawing from their fund or withdrawing from their bank, they are unable to fund those. The big one, of course, that we look at is Lehman Brothers. Often, as we're going to see in topic 10 when we talk about the global financial crisis, Lehman Brothers is often referred to as the tipping point. That's the key point behind what went wrong in the financial crisis that not caused, but it was the start. We'll look at Continental, Illinois Bank, and then Northern Rock. Okay, just starting off with the Lehman Brothers. Okay, prior to the crisis, okay, the largest group of market participants were the institutional guys. Okay, and they invested principally with these firms called shadow banks. Okay, um, and some of the concerns over here is you had U.S. Treasuries, which are a very secure form of investment, were in short supply. Okay, um, and as a result, people were looking towards the shadow banks as a form of an investment class to invest in. And some of the assets were repos, okay, and ABCP, asset-backed commercial paper, okay, um, and often we blame these repos and the ABS or asset-backed securities again as one of the reasons for the crisis. Another part of the crisis, as we know very well, was the subprime mortgages. There was these mortgages that were subprime, means very low quality, okay, which meant that and these mortgages, these very low quality mortgages, were being used as the asset. Okay, when we talk about asset-backed securities or asset-backed commercial paper, okay, these asset-backed securities were very low quality assets, okay, because they were being lent to people that could not afford them, and as such these mortgages were termed subprime mortgages. In other words, they were lent to people that could not afford them. So the asset that sat on the bank's balance sheet in terms of a loan, it was a loan to a person that could not afford it, called a subprime loan, and it was a very poor asset quality. Okay, and obviously, as we know, as housing prices fell in 2007, the market collapsed and everything else. The assets that were backing this up dropped as well. Okay, good. We turn over here. I'm not going to spend too much time. I've gone into probably much too much detail for you over here. But one of the key things, okay, that we need to find out, to know over here, okay, is that what happened with Lehman Brothers. And we'll start over here again. Okay, Lehman Brothers, what used to happen is as their debt became more, as they needed to pay their debt or to refinance, they were using this thing called a repo. Now, a repo, okay, is a very short-term form of finance. Okay, Lehman Brothers, okay, sorry, just before we go there, one of the key services of a prime broker, okay, is to provide this type of repo financing. Well, that's one of their key jobs. Now, the prime broker of Lehman Brothers was JP Morgan. Okay, so every morning when Lehman Brothers needed to roll over their debt or to refinance their debt, they would phone JP Morgan. JP Morgan would refinance the debt, and Lehman Brothers had more money to carry on with their operations. What happened as the crisis got worse and worse and worse, and as Lehman Brothers became further and further geared, JP Morgan said, no, enough. And the next morning when Lehman phoned to roll over their debt, JP Morgan said, no more debt for you. In other words, they froze up their sources of liquidity. Lehman was no longer able to refinance, and as such the business failed. Quite simple, really, and as you can see, okay, this was a case of funding liquidity. Very important that we get the terms right. It was a case of funding liquidity, that the funding for Lehman was dried up. Okay, various reasons. We saw a little bit about that before, due to the subprime crisis, etc., etc. Okay, but that was the source of it was as a result of JP Morgan freezing up their liquidity. Okay, we carry on over here. And as we can see, in September 2008, Lehman Brothers filed for bankruptcy. Okay, as we mentioned before, that was a major tipping point in the financial crisis, leading to both systemic as well as a contagion to follow. Okay, and that was the big one. We move down to the next one we're going to look at is Continental Illinois Bank. Okay, it was a large bank in Chicago, pursued an aggressive growth strategy, and as they grew their lending book. Remember, if you've got your lending book, that's your assets from 5 billion to 14 billion. Okay, now remember, as your assets grow, in this case from 5 billion to 14 billion, well, I've got to finance that, I've got to fund that. Where does the money come to be able to lend people that additional from 5 to 14, that additional 9 billion? Where's that money coming from? Where am I getting that money from? Okay, good. However, during this period, we'll discuss that in a second. During this period, okay, um, being a large bank, okay, they took on business that the smaller banks were unable to, and they started to get some nice money in. Okay, a large portion of this loan book was linked to oil and natural gases. Okay, and it had a boom in the 70s, so everything was going well for them in the 70s. But remember, okay, when a business is linked, and I'm just going to mention another risk over here. It's not specifically linked over here. It's not termed over here, but we'll give it another name over here. Okay, when a business is linked to a specific sector, oil, and in this case natural gas, the one risk that comes to mind, guys, and please remember this one, we call concentration risk. Concentration risk is when a big portion of your business is in one specific area or sector. Yes, when that sector is doing well, like oil and gas in the 70s, well, that was great. However, in the early part of the 80s, oil prices began to fall, and then as oil prices fell, customers began to default on their loans. Okay. A key weakness in their model is that they relied mainly on federal funding and certificates of deposit. Okay, very little on core retail deposits. Most retail banks rely for their funding from their customers. Okay, the problem was Continental was borrowing from the government. Okay, federal funding and certificates of deposit. Okay, and as the market started to fall, okay, they couldn't keep up borrowing from the US markets. They turned to the overseas markets to try and get more funding from them. But the problem was the overseas markets charged more. The rates were higher. Okay, and again, as you can see, the market, everything just started to fall over as the overseas borrowers became more and more aware of Continental's defaults. They withdrew their funds, and as they withdrew their funds, well, then the business just fell over. And look at this massive number. The depositors withdrew $6 billion in 10 days. Now, the minute you see $6 billion leaving a company of this size in a short period like that, creates a full-blown liquidity crisis. Okay, and as you see, often what you see, the last words that we write at the end of each of these things is the regulatory authorities were forced to step in. Why? To prevent a systemic crisis. And the two things that we're always looking for, guys, is systemic issues, as well as that risk, okay, might be pushed forward onto to spread, which we call a contagion. We move to the next disaster called Northern Rock. Okay. It was a medium-sized bank in the UK, dealing mainly in mortgages, mainly loans, okay, and mainly what type of loans? Residential mortgages, okay, and it was an originate to distribute model, okay, and in other words, an OTD model, or an originate to distribute model, means they originate the loan, but they don't intend to keep that loan on their balance sheet. They're going to distribute that loan or push it out into another kind of a structure. We'll deal much more with this when we look at securitizations and things like that. Okay, good. How do they rely on their funding? Where did their funding come from? Okay, much more an investor base as opposed to retail deposits. So while the model, the market, the investor market was doing well, as we saw up until 2007, well then yes, the money was flowing. When that market seized up and the liquidity went away, so too went their business as well. Okay, and the same story, guys, that we saw in Lehman, subprime debt, and all of that caused the markets to fall over. I'm not going to spend much more time on there. Same old story. The bank was saved by government support, followed by public ownership. Why was it saved? In order to prevent a systemic crisis. Some of the lessons that we learn over there, okay, that the Federal Reserve, and we saw this a little bit in the previous topic, okay, is things like when the Federal Reserve stepped in after the crisis, they needed to look at things like stress testing and all good things like that. Okay, we have a look over here. Funding, liquidity, and interest rate risk. Very important to remember. The shorter the duration of the liabilities, the more exposed they are. Okay, so the problem is that if their liabilities, their funding liabilities are short term, they can be pulled out at any moment and they can no longer fund their assets anymore. Their risk is very high. Okay, cost and risk mitigation. Okay, in order to mitigate funding liquidity risk, okay, what they can do is they can increase the duration of their liabilities. The problem is it's more expensive than short duration funding. So often banks like to keep their funding structure or their liability structure quite short term, and the reason they do that is because at this area the interest rates are generally a little bit lower. Okay, so they can mitigate their risk by doing what? By going more longer term liabilities, but the problem with that is the interest rates at that level are higher, reducing their profits there too. Okay, we look over here. I'm on page 5. We're going to go to the third risk that we look at: implementing hedging strategies. Okay, good. And when looking at implementing hedging strategies over here, okay, we look at two particular things. We look at static hedging. Static hedging is when I enter into a hedge or a position. Okay, I enter into that position, it's static. It never moves throughout the period of the underlying position. I keep it as is for that entire period. Dynamic hedging is I buy a hedge, okay, and I constantly adjust that hedge, okay, to manage my underlying exposure. I've got an underlying exposure that I'm looking to protect or I'm looking to hedge. A dynamic hedge keeps moving with that particular underlying exposure, and a static hedge just stays as is, as it was initially at inception. Okay, we look at this. It was a German company, and please excuse my pronunciation. I'm just going to call it Mattel, but as you can see, guys, there's a much longer name behind Mattel. Okay. And what we look over here is the strategy that they employed. Okay, they had an American. It's a German company. Okay, that was involved in gas and petroleum prices supply. And what they did, okay, is they then had an American arm. Okay, and what this American arm of Mattel did was they said to their customers, "What we're going to do for you, of course, for a fee, nothing in America happens without a fee, okay, I shouldn't blame America, it's everywhere, of course, okay, is we are going to protect you against an increase in gas and petroleum prices." Okay, and what Mattel in America did is they offered their customers fixed prices on gas and petroleum for a 5 to 10 year period. Okay, they had a whole scheme. The price charge was a premium over the average 12-month futures price. Okay, and customers were then allowed to exit if the spot price rose above the fixed price. So, if the actual price in the market was higher than their price per their contract, okay, they were allowed to exit. So the customer was effectively protected. Okay, the problem with this, okay, is MG and Mattel, if you look at what they were trying to do, they had promised to supply gas to their customers 10 years ahead. Every year they were going to be supplying. So they were in fact massive sellers, okay, of gas. In fact, if you look at their position, we say they had a short position in the futures market. In other words, they were selling gas and petroleum forward. Okay, now they've effectively sold all this petroleum and this gas, but the problem is, where were they going to get it from, and how were they going to fix their prices to make sure that their prices didn't rise out of control? So what did they do? They entered into a fancy structure called a stack and roll. Okay, so what they did is they would buy futures contracts. Okay, and as this particular amount of futures contracts reached expiry, they would sell them and they would buy some more. In other words, they would roll it forward. Okay, good. So what they were doing is that they had a short position. And how do they manage their short position? In other words, a short position means they had already sold. Short just means sell in a derivative speak. So they had a short position. In other words, they had promised to sell to their customers for a period of 5 to 10 years. They promised to sell. They had a short position. How do they manage the short? How do you manage a short position? Well, you go long. So how did they go long? They bought futures contracts on gas and petroleum. So they had a nicely matched position. They had sold forward, so they bought forward as well. Nicely matched position. Okay. As the futures contract expires, they rolled over and they took another one out. The problem is, number one, is that they had sold forward very long term, and futures contracts are a very short term instrument. So that's why they were rolling all the time. They couldn't just say, okay, well, we've sold forward 5 years, let us buy ourselves a 5-year futures contract. That they couldn't do because there wasn't 5 years future contracts in the market at that particular point in time. There was only short-term futures contracts. Okay, good. That was the only alternative in the market. Okay, and look at this. Their position, they were so heavily into the market that in 1993 they had contract positions, open positions, okay, of 55 million barrels of gas. Okay. At the end of 93, when they cashed out their positions, they lost 1.5 billion. Remember, this is 1993. 1.5 billion is a massive amount of money. And look over here. Here was part of the problem. We'll look at the various issues. They had a mismatch between their short-term futures and their long-term commitments per their contract. So they were long in the short term. They were long. They had bought, okay, and in the long term they had sold. But there's a mismatch between the calendar periods over there. Okay, good. Okay. And the truth is, had they managed to weather the interim storm of on those particular contracts, because remember, as they bought and sold, remember we said it was a roll, a stack and roll. If I just take you back a page, let me just show you that over there. Okay, clean up here. It was a stack. This is a very important part of the issue. They had a stack and roll strategy. Now, if we look at a stack and roll strategy, if we look here. Let's just give ourselves a bit of a time period over here. So we look over here, there's time period 0, they entered into the contract, there's time period 1, etc., etc. And what happens over here? Here they entered into the contract, and here, that's what we call the stack, and here they had to roll it forward to the next period. Now remember, when they rolled it forward to the next period, at that point in time, there was obviously a difference in price between what they had bought it for. Because remember, how do you roll it forward to the next period? Okay, you own it already, so now you need to sell it. Okay, that's when you can incur a loss, because remember, over here you entered into a contract. Here you need to sell it to get out of it, because you don't need it now, because remember, you only need it to be sold long term. So you bought it, now you need to sell it. Now you can get a loss over here or a gain, and then what do you do again? To go forward to time period 2, you buy again. That's called the roll. Now what happens in time period 2? You've bought something. Remember, I bought it over there. I don't want it now, so I need to sell. Again, I can incur a loss or a gain over here. I don't need it yet, so I need to roll it forward again. And as you can see, at each period where they were doing their stack and rolls, it was a buy and a sell transaction. And at that point in time, there was gains and losses being lost. And that's what we talk about over here on top of page 6. Okay, I'll read it to you verbatim. Many experts believed that it would have been a great strategy, the stack and roll, if they were able to weather the interim cash flow requirements. Because remember, during this particular period, there were gains and losses at these stack and roll positions. And they were not able to manage those cash flows at that particular time. And we say over here, MG's biggest issue was what we call cash flow risk. They weren't able to manage the cash flows at those particular points in time. Okay, good. And here we go. The reasons for this is that the instruments were not similar. Futures contracts wanted payment right now, and the contract as per the customer, when did the customer pay you? Those were long term. So it's short term futures contracts versus long term payments. And we say over here quite clearly the cash flow mismatch, okay, and in addition to that, an increase in funding liquidity risk. What happened then? Oil prices fell, compounded the problem, okay. MG was forced to close out their positions, incurring massive losses, okay. Interestingly, another thing that we see over here, which also led to their disaster, okay, we'll just talk about this also in a minute, German accounting rules forced them to report losses on the futures contracts. They weren't allowed to show any gains on on the gains that they made to their customers, because remember, at some point they were, if they were losing on the futures contract, they were gaining on the customer contracts. Now the problem with that is, well, that's fine, but according to the German accounting rules, they weren't allowed to show the gains, but they were forced to show the losses. So that showed their financial business being much worse than it actually was. And if you're showing the market a position that's actually much worse than it is, in addition, that will cause a loss of confidence in the market as well, and cause their funding to be even worse. As you can see, credit lines dried up. Okay, and even the firm's margin requirement was increased. Everybody was panicking. They saw these terrible results, and they started to dry up the funding. Okay, good. The cash flows may have been manageable if it wasn't, again, for the massive size of the positions, which we saw on the previous page. It would take up to 10 days to liquidate. Okay. As a result, we say the company was subject to trading liquidity risk, okay, which needed to be managed much more carefully. Okay, and that's MG. And what's interesting about this case of MG, and we're going to see it time and time again, we'll see it quite often in FRM Part 2, is don't be surprised, okay, is when you have one disaster that disaster is compounded further by a second disaster. As we can see over here, as the market started to crash, well, then they got hit also by the German accounting rules that hurt them as well. And often that's what happens when you get these financial disasters, is they are compounded. We'll see what those risks are going forward, but what typically happens is, as you get one disaster, it is compounded further by a second disaster. Okay, we move on to model risk. Okay, and very briefly, I'm not going to spend a whole batch of time on this. Okay, but when we look at model risk, we always talk about the thing that should always come to your mind is what the Americans called GIGO, garbage in, garbage out. If rubbish goes into the model, what will come out will be rubbish as well. Now, in addition to that, working with very complex models, again, you've got to make sure that those models are properly tested, calibrated, etc., because if they are not, again, if rubbish goes in, rubbish will come out, and the more complex they are, the more chance there are of one little disaster, which could in fact, for a more complex type of a model, okay, could in fact sink an entire business. Okay, we move on. And we look over here, guys. Don't spend time on this. I want to get straight to the particular case. But we look at some of the more common modeling errors. Okay, some of them are constant volatility assumption. If you look at what we call, we're not going to see this now, guys. But the Black-Scholes, okay, Merton model assumes that volatility is constant throughout the period. Okay, not a correct assumption. It also assumes a normal distribution. It tends to underestimate risk, okay, because you often only work with a single risk factor. We're assuming a perfect capital market. We're assuming that the markets are fairly liquid, which again, as we can see, when the markets tend to dry up, is not the case. And the last one is model misapplication. Okay, good. And do have a quick look at those, but please don't spend a whole lot of time on those. That's not the focus of this particular topic. Let us move down to the particular case that we're looking for over here in terms of model risk, and these are very, very important, particularly number 2 and 3, which is LTCM, long-term capital management, and London Whale. No disrespect, of course, to Niederhofer, okay, but that's not as prolific as the other two are. We'll start with Niederhofer. Okay, and Victor Niederhofer was a trader. He ran a hedge fund. One of his strategies was to write uncovered or naked options, okay, on deep out of the money put options, okay, on the S&P 500. Now, all of that's a huge mouthful. Let's break it down bit by bit. Number one is he used to write options. What kind of options? Number 2, we used to write put options. Number 3, they were deep out of the money. And number 4, they were naked. Okay, so let's break down each of these particular points as we go. Okay, and slowly. Okay, now before we can look at this, and it's not the right place, but I'm going to give you a brief introduction. We'll come back to this page, but over the page, I'm going to give you a brief introduction to, as per this, the edge note that we've got over here. Okay, the various option positions. Now, very important. Okay, and as I say, this is not the place for it, but we will deal with it now. Otherwise, it makes this a little bit too difficult to understand. We start over here with options. Okay, now when we talk about options, remember an option, okay, very important as a derivative instrument, that you have an option, you don't have to deal in the case of an option. Let's talk about this a little bit before. Let's say, for example, I've got an option on Apple Corporation stock. Okay, yes, that's Apple. Okay, let's say, for example, there's an Apple Corporation stock, SO. I'm going to use some of the notations. SO, the spot price at time period 0. Now, let's say, for example, I'm not sure what it's trading at, around about $300. Let's assume that. Now, you believe, okay, that the price of Apple Corporation stock is going to go up in the next time period. Let's make it a time period of 3 months. I believe it's going to go up. What kind of a call option would I do? I'd go for a long call. We'll talk about that in a second. What do I believe? I believe that the price will go up to well over 320, 330. So what I do, I put what we call an X. X is what we call the strike price, and I make my strike price 320. Now, what does that mean? Okay, first of all, I bought, and we'll see. There's a little bit of a cost in being long, in buying it. And this, I'm going to call that CO. The cost of the option is, let's say, $5. What does all of that mean? Let's break it down. Okay. Number one, okay, is that the period of my long call is 3 months. Time period is 3 months. Okay. And what I'm saying is that the current price is $300. I believe that it's going to go above 320 in three months' time, and I'm prepared to pay a call option amount of $5. Long means, remember in derivative talk, long just means that you buy. Okay, so I am long a call. Now, if we look over there, what does this mean? So let's just say, for example, let's break it down, comes at the end of time period 3. I'm going to go to over here, S spot price at the end of time period 3 is equal to 350. What does this mean now? Well, what this means is that a long call means I've got the right, long, I bought call, I've got the right to buy Apple Corporation stock at what price? At the exercise price. I've got the right to buy Apple Corporation stock at $320, okay, at this time period. Would I exercise my option? Of course I would, because what would I do? I can buy Apple Corporation stock at 320, and I can see quite clear the current price is 350, so of course I would do it. I would buy for 320 at the end of the 3 months per the exercise price, and I would sell for 350 the very next second, and I make $30. My profit over there is $30. Remember, of course, I don't make a full $30 because it cost me $5 to buy the option. My net profit will be $25. Okay, now remember, why did I have to pay $5 for this option? Because I was long. I bought the option. Remember, when you buy an option, okay, you buy the right from someone else to buy from them. You've got the option. If you want an option, you've got to pay for it. If I look at another example, let's say, for example, that time period S3, Apple Corporation had gone down to $250. What would I do? Let's break this down. At $250, I've got the right, but not the obligation, to buy Apple Corporation stock at the exercise price of $320. And I'd be crazy to do that, wouldn't I? Why would I buy Apple Corporation stock from you per my options contract at $320 when it's trading at the market at $250? So what would I do? I would walk away and I would not exercise. Hence the term option. But who's got the option? Only the long. He bought it, and that cost him $5 to buy it. Now, very important, who is the counterparty? Who's the other side of a long call? Okay, it's a short call. The short means sell. And what did he sell you? He sold you a call. What's a call? The right to buy. So a long call means, okay, you've got the right to buy. A short call means you sold somebody else the right to buy from you. And what does the short call get? Why would someone else sell you the rights? Well, they're going to receive the $5, aren't they? They get the $5, and that for them is what they receive as compensation for selling you a call option. Okay, and that's the picture. Now remember, very important to remember in this particular structure. Okay, if we just clean up here just a little bit, when I say to you that options and people have got rights, etc., who has got the rights, the option? Only the long. Why? Because he bought it. Long means buy. He bought the right to buy. But the short call, he sold someone else the right, he has no option. Very important. He has no option. Why? Because it would be a bit ridiculous if the long call and the short call both had options. Well, then a trade would never happen. So remember, the long call, yes, he's got an option because he paid for it. He paid the $5. The short call has no option because he sold something, and therefore he has no option. If we just take it down to the notes over here, long call, I'll read it to you over here. The long is the buyer of the option has the right, but not the obligation to buy at the exercise price. The short, who's the seller, has the obligation. You happy with that? To sell the underlying instruments to the long call at the exercise price. There we go. So very important to remember that a short call, okay, has an obligation. A long call has the right. Now, just to go a little bit deeper into options, I know this is not the place, but we do need this for our understanding. Okay, we look at these things called puts. What's a put? We dealt with calls. What's a put? A put is to sell. Exactly the other way around. Let's say, for example, you're dealing in a stock that is you're quite sure that it's going to drop in price. What would you do? You would enter into a long put. A long put is long is buy, put is sell. So in other words, the long, okay, or the buyer of the option has the right to sell. When would you sell? When would you enter into a put? Okay, then would you go long a put when you believe that prices are going to fall. Okay, good. And a short put then is you sell someone else, okay, the right to buy from you. Okay, good. And that's basically what we're looking at over here. Let's have a look at our example over here. Let's see what he did. Going back. Okay. Now, when you write just means to sell. Now remember, when you are selling an option, and a naked option means that there is no protection for you. You don't own the asset. You don't have something that can cover you in any way. In other words, you've got a naked position. In other words, any loss that you make, you've got to cover those losses yourself. You don't, for example, you don't own shares that could cover them. You don't own anything that could cover up this particular loss. You've got a naked position. Remember, when you are writing, means you are selling. And remember, we said on the following page, if you sell, you have no option. The only one that's got options is the buyer of the option, not the seller. Okay. And what was he selling? He was selling deep out of the money put options. In other words, deep out of the money, what did he believe? Deep out of the money means that they're so far from being profitable for the long. He thought he's just going to make money on them easily. Okay, what was he assuming? He was assuming, and I'll just give you an example. Let's just peek over here. No, okay, good. Not what I was looking for. Let's have a look over here. Let's have a quick look. Now, and let's just give you a brief example. Okay, now, we're dealing with a short position, okay, and put options. Let's have a quick look at how this whole thing will work. Let's pick ourselves a stock, okay. everybody's favorite stock to short. I'm not sure why, because it's risen so nicely. Let's pick on Tesla for a second. Now, let's just assume we're dealing with Tesla. Yes, that's a bit of a car, best I can do. Okay, there we go. Okay. I'm not sure what you guys are saying in the background. Probably that looks a bit like maybe like a cat or something else. But yes, that's my version of a car. Now let's just say, for example, Tesla is sitting SO current spot price. Let's make it. It's not correct. I know, $800. Now, what if you believe? Okay, I'm going to look at it from both points of view to give ourselves a complete understanding of this particular section. Maybe taking a bit longer than we had anticipated, but that's fine. We'll do things slowly to make sure we understand everything completely. Okay. Now, sitting at, and let's say, for example, I'm going to set ourselves a time period of 3 months. There we go. Okay. And let's say, for example, you believe the price will go down to $700. Okay. No, in fact, let's set that much lower. Let's make that $400 to fit in nicely with our example. And for that, we're going to call it PO. There was a put option amount of $1. What does all of this mean? Now, let's have a look from both parties. Okay. Let's have a look at it from the long and from the short. Remember, Victor Niederhofer was on the short side. Okay, so what was the long thinking? The long was thinking a bit of a crazy thing. The long was thinking that Tesla is going to drop from its current levels of 800 to below 400. Wow. Okay, that was the long's thinking, and the long was prepared to pay $1 for that. And when would the long make money? When would it be profitable for the long? If, I'm going to call it, if S3, which is the period in the time period 3, okay, at the end of the 3-month period, if Tesla was below $400. Happy with that? And of course, you can see that's a crazy assumption. I mean, what's the probability of Tesla dropping $400 within the next 3 months? And that's what Niederhofer was saying. It's impossible. And that's why we call these what? Deep out of the money options. There's no way this is going to happen. They're so out of the money. When would we call them in the money options? Or, for example, if the X, if I set my X, let's say, for example, to be $800, which is exactly the same as the price now, we would call that at the money options. But these are deep out of the money. There's no way, and that's what Niederhofer was assuming, there's no way that these options are going to fall $400, that the stock price within a 3-month period will fall more than $400. So what was Niederhofer saying? He was laughing all the way to the bank and saying, ha ha ha, very nice, pay me the dollar, the option, I'll just bank these dollars as they go, because it's impossible that the stock is going to fall $400. And Niederhofer would have been right in what we would call a normal functioning market with very little volatility. Okay, now let's see what happened. So obviously, what was the long assuming? Number one, a lot of volatility, increased volatility in the market, as well as almost a market crash. Okay, they were almost expecting a bit of a market crash, that prices would fall so completely to take their deep out of the money position to becoming an in the money position. Let's see what happened. Okay, good. Okay, good. And okay, look over here. The strategy behind selling, which was Niederhofer's strategy, or writing deep out of the money put options, is that it's unlikely that the market will decline precipitously at any given day. In other words, the assumption was the markets would behave in a normal manner. Let's see what happened. And then obviously, over here, guys, I have given you the picture over there. Okay, good. And if you just wanted to focus over here, guys, this is Niederhofer's position, the short put. Okay, the strategy failed because obviously everything went against him, because when did he get hit? He got hit in October 97 when the market fell. Okay, the US market fell hugely. The Asian crisis hit at that particular point in time. Okay, and Niederhofer had to made massive losses. His positions were liquidated and his fund was closed. He needed to make over $50 million in margin calls, which was a massive amount of money in 1997. Okay, still a massive amount of money now, but obviously much bigger in those days. Okay, and guys, we've jumped you in quite hectically into to options, but unfortunately we needed to have a bit of an understanding of that prior to being able to understand what we were doing over here. We moved to our next one, which is called LTCM, which is long-term capital management. Okay, it was a hedge fund. This is a very a popular one, formed in 1994 by a team that left Lehman Brothers. Okay, and part of the long-term capital management allure was that they kept everything quite secret. No one spoke too much about what was going on in the fund. No one gave away too many details. It was very quietly managed. Investors didn't really know what was going on. Their funds were locked in for long periods of time, etc., etc. Okay, good. Interesting, and another aspect of long-term capital management was their level of leverage. Okay. At one point in time, just before their fund collapsed, okay, they had $125 billion of assets and only $4.7 billion in equity, which means that the difference, around about $120 billion, was funded. $120 billion was obviously then equal to the liabilities, or they were funded. Their leverage, their debt was 28 times leverage. Okay, and remember, that's not even the true leverage, because remember, these assets, okay, were invested in things like derivatives, okay, which the actual value of the derivatives is not 125 billion, which is closer to 1 trillion. Okay, because the investment of the asset was made into derivatives, not into an actual asset, and the value of the underlying asset was approximately 8 times greater than what was being reported. The obvious question is, how did this happen? How did they get to these levels of leverage? Okay, and very interesting, we see over here, okay, this amount of leverage was allowed that many financial institutions waived their margin requirements. But what do they say? Sure, these guys, I mean, if you look at the guys that were here, there was John Merriweather, okay, Merton Miller. These are really massive people within the industry, and what they did is they waived their margin requirements. So this LTCM became a massive risk. Okay, one of the key strategies behind LTCM was called a convergence strategy, relative value or convergence. And what they believed is that if you've got two kinds of fixed income securities, let's say, for example, I've got let's put them over here. I've got a US Treasury, for example, and I've got a corporate bond. Okay, US Treasury trades at a yield of 2%, a corporate bond, let's say, at 4%. Okay, which means I've got a spread of 2%, and that's the normal okay position that we see. What happens, for example, if at some point they start to spread? In other words, the US Treasury stays at 2, but the corporate bond moves to 7%. Now the spread is 5. What LTCM believed is that it'll never stay at 5. It's going to go back to 2. In other words, mean reversion. It can't stay at 5. Okay, and that what they did is they took massive positions at the 5 with the belief that it would go back down to the 2. It would mean revert. Okay, it would converge. That the old trading pattern would go back to as it was before. Okay. In addition to that, they were also trading equity options. In addition to that strategy, the convergence strategy. Okay. And again, when volatility was too high, they would sell volatility in anticipation of it returning back to normal. The problem was that neither of these things happened. Volatility never returned back to normal, and these particular normal trading patterns never converge. And there was 2 reasons for this. Reason number 1, okay, is in 98, at this particular point in time, Russia defaulted on their debt, sent interest rates rising, sent the Russian ruble crashing. Okay, and that again caused this particular spread to widen even further. They were hoping that it would converge and just widen further. In addition, as we mentioned before, when a crisis happens, a second crisis follows shortly thereafter, and Brazil devalued their currency, rates rose, increase in volatility. And what was LTCM hoping for? That rates would converge, number one, and volatility would decrease. All of these events caused the spread to widen. In addition, it caused volatility to increase, not to decrease. They lost 44% of capital in just 1 month. They had to liquidate, and as you see, they were bailed out by the Federal Reserve. Okay, one of the key errors. Okay, let's look at some of the key errors over here. We'll just focus on the first two. Number one, okay, was model risk. They assumed that their models and that historical relationships would persist in the future, and that if, for example, that the old relationship moves away, well, it's going to for sure come back to where it was before. That, of course, never happened. And number two, okay, they believe that correlations among risks do occur, okay, but that you might get two events followed by one by another, almost impossible. Okay, and that wasn't the case, as high severity events was followed by another high severity event, Russia followed by Brazil. Okay, good. Okay, and that was LTCM. Okay, some of the lessons learned. Let's pick up on some of these. The initial margin needs to be collected irrespective of the counterparty. It doesn't matter who you're dealing with. You've got to collect your margins. Liquidation costs must be considered when investing. The fund had a 10-day value at risk calculation, which was much too short, needed a longer period to liquidate. There must be greater disclosure. Don't go into funds if you don't know what you're investing into, guys. Correlation risk and volatility risks must be incorporated into a model. These were not incorporated into the LTCM model. Okay. Stress testing, and this is what we saw again after the 2007 and 8 financial crisis. The bank started some severe stress testing just to make sure that they had captured all of the various risks, and to see what can happen if, okay, the worst case. Don't be scared to assume an absolutely disastrous scenario. Okay, and last point, a little bit tongue-in-cheek, even the best investors can fail. And if you guys get a bit of time, there's a lovely book written by Roger Lowenstein called When Genius Failed. Do take a peek at that if you can. Let us have a look at a typical exam question now. Okay. The collapse of LTCM is a classic risk management case study. Which of the following statements about risk management at LTCM is correct? A, LTCM had no active risk reporting. No, they had limited, but they didn't have none. Watch for the harsh statements like no. That's not correct. B, at LTCM, stress testing became a risk management department exercise that had little influence on the firm's strategy. Also not correct. We don't know anything about that. C, LTCM's use of high leverage is evidence of poor risk management. Again, that's not correct. You can use a high amount of leverage, but just manage that risk correctly. But it's not evidence. High leverage does not equal poor risk management. It's also not correct. Okay. And D, obviously, and at this point, guys, you are praying that D is correct because you've already selected A, B, and C as being wrong. Let's have a look and make sure that it is. LTCM failed to account properly for the illiquidity of its largest positions in the risk calculations, and yes, that's correct. As a result of them not being able to cover those positions, they were in an illiquid position, and resulted in a large loss. Okay. Let's look at the last one over here in this particular section. We've looked at Niederhofer. We've looked at LTCM. Let us have a look at the London Whale case. Okay. Some of the case facts. JPM, was a major international derivatives player. Okay. They incurred a massive loss as a result of a synthetic credit derivative trade in 2012, the total amount being $6 billion. And the name given to the trader that made those massive losses, they called him the London Whale. Okay, The chief investment officer at JP Morgan was the one that was in charge of that, and he, unfortunately for himself, got the name the London Whale. Okay, and London, of course, because he was in charge of the London desk where the losses came from. Okay, and what happened was the bank had about 350 billion in excess deposits. Okay, he, as the CIO, was responsible for managing these deposits. Okay, and in addition to managing the deposits, these huge excess deposits, he was also told to keep the risk of the investments at a low. Okay, but instead of keeping them at a low, what did he do? He invested in high risk credit derivatives. Okay, within the bank's SCP, synthetic credit portfolio. Okay, and a very risky department. Okay. And what happened was he was told in 2011 to reduce the bank's risk-weighted assets, okay, in order to try and reduce the regulatory capital. Remember, regulatory capital that is required as per Basel will depend on what kind of assets you've got. So the higher the riskiness of those assets, the more regulatory capital you need. So he was told that he needed to reduce his risk-weighted assets in order to reduce the risk of the bank. And instead he took long positions in synthetic credit derivatives, okay, to offset the short positions in their synthetic credit, okay, derivatives portfolio. Okay, the problem was that overall, by going long, buying into synthetic credit derivatives increased the overall risk. Okay, and as a result of previously, when they had lovely hedges in place, this reduced the previous hedge that they had in the past. Okay, and look what he did. He was aware that he had breached his VAR limits. So what did he do? He set new limits. And what do these new limits do? They just reduced the VAR calc by 50%. So instead of needing a certain amount, now he needed that much less available, and his positions looked so less risky, because what did he do? This is model risk. He just changed the VAR calculation. Okay, and his new limits allowed him to carry on with his risky trades and still remain within his VAR limits. Now the problem was when he changed that, no one picked up on that. Okay, because it looked like his VAR, or his value at risk, was still quite acceptable. Okay, in 2012, it was making huge losses, and what did he do in order to hide his losses? He went back to his old trick of model risk again. What did he do? He just changed the way he valued things. Generally, what do? We value at midpoint pricing. In other words, when I'm looking to value how much I need to pay on a trade, okay, I look at the midpoint between the buy and the sell. So what did he do? He just used the most favorable pricing, be it the bid or the ask, the sell for that day. He didn't care as long as it gave him a better price. So he used that. So obviously the CIO was quite malicious in his actions. Okay, on two sides he changed the VAR calculation, and then he changed the pricing calculation, both model risks. Okay, total losses 6 billion. Okay, come the lessons learned. Risk limits were ignored, poor risk culture at JPM. Okay, and risk models were changed to hide risks and losses. Okay, we move along. Okay, to some rogue trading and misleading reporting. The king over here, as we know, was obviously Barings Bank. Okay, and we look at Nick Leeson. Nick Leeson was a junior trader from Barings Bank. He worked in Singapore. Okay, he lost 296 million at one point in time. We're talking about these final losses. Okay, and at the same point in time, when he lost 296 million, he reported gains of 46 million to his bosses in London. So his bosses thought, whoa, this oak is doing brilliantly. Okay, and everything is good. Everything is good. They kept on sending him more and more money to fund his positions. In addition to that, sending him more money, what did they also do? Okay, they gave him bonuses. Okay, but in truth, he was just hiding losses. Really, it was just purely a bit of a. He was a rogue trader, nothing more fancy than that. Let's have a peek at Nick Leeson's two main trades. One of them was shorting straddles. Wow. Okay, another one is an arbitrage on the Nikkei 22 5. Now, let's have a quick look at what does it mean shorting straddles? Okay, a short straddle. Okay, now a straddle, okay, is as follows. It's a straddle is purely simple, but a straddle is just a volatility trade. Okay, now what does a volatility trade mean? So what you do is you enter into both a call option and a put option. Okay, and let's say, for example, I am long, I buy a call and I buy a put. I buy them both. Let's say, for example, the current spot price is 100. Okay, I will set both my exercise prices at 100. Okay, now what does that help me? Current price is 100. Okay, I go call and puts. Okay, if I am long a straddle, what am I doing? I'm hoping for volatility. In other words, I don't care which way the market goes. I don't care if the market goes to 120 or I don't care if the market goes down to 80. Okay, I'll make money on a long straddle. This is a short straddle. We'll talk about that in a second. A long straddle, okay, you pray for what? You pray for volatility. Why? Because you're hoping that the market moves. You don't care which way, because if the market moves up a lot, I'll make money on my call, and I won't exercise my put. If the market goes down to 80, I'll make money on my put and I won't exercise my call. So all that you care about in a straddle, if you are long the straddle, is that you want lots and lots of volatility. You don't care which way. Nick Leeson went short a straddle. So he was on the other side of the straddle. What was he hoping for? He was hoping for no volatility. A nice calm market. That's what he wanted. Okay. Nick Leeson just wanted a nice calm market. Okay. That was his one strategy. In other words, he wanted the price to sit anywhere between 100, maybe 101, 99, but not to move too much away from those, and then he would make his money. Okay. So he was hoping for no volatility. Okay. His second position, okay, his arbitrage strategy that he entered into, okay, was that he was long futures on a cheaper exchange and short futures on a more expensive. So in other words, that's your stock standard arbitrage strategy. Is, in other words, you buy the same asset. You buy, let's call the asset asset X. You buy X where you buy it on the cheap market and you sell it, exactly the same asset, on an expensive market. That makes sense, doesn't it? Always, if you want to make money, the easiest way to make money is you buy something cheaply and you sell something expensive. But it's exactly the same asset, isn't it? Okay, and that's called arbitrage. Arbitrage is when exactly the same asset trades at different prices, okay, in different markets. What happened to Nick Leeson? Okay, he was praying for no volatility. What did he get hit with? An earthquake. No greater volatility physically and market-wise than an earthquake. Okay. In addition, he believed that some of his arbitrage was riskless. It wasn't riskless at all. Okay, and his total losses totaled 1.25 billion. And what was interesting is that this caused the Bearings at that point was called the Queen's Bank. Okay. And it broke the Queen's Bank. That was the end of Bearings Bank. It was sold apparently for about a dollar, okay, to a Dutch bank, and that was the end of Bearings Bank. Okay, what are some of the things that went wrong? Okay, let's have a quick look. Okay, there was little, if any, management oversight for Leeson's trades. The reporting structure was ambiguous and convoluted. Okay, very important to remember that Leeson's manager at the time resigned, so he was almost free to do what he wanted. Okay, he was allowed to cover up his losses. In addition, management didn't fully understand how the money was being made, and this is a vital one. Number 3, guys, is if you as a manager, as you as a director, don't understand how profits are being made, get out of those particular positions. There's no need or reason or even anything to be in positions where you don't understand how they're being made. Okay, because the problem, Leeson was presenting riskless strategies, but yet he was showing massive profits. On a riskless strategy, arbitrage, there's minuscule profits, not massive profits. Yet management never understood this, and they kept sending him more and more money. Okay, there was a lack of management oversight, trading and settlement responsibilities. So the trading and the settlement must be different people. You need a system of checks and balances in place to be able to manage the business. Okay, we move down to financial engineering and complex derivatives. Okay, have a look over here, and the three that we deal with over here is Bankers Trust, Orange County, and a company called Sashin. Okay, Bankers Trust was hired by Procter & Gamble and Gibson Greetings, okay, to assist them in reducing their funding costs. Okay, and Bankers Trust made use of derivative trades to drive down the costs. Okay, had a low probability of a very large loss. Okay, the derivative trades resulted in very large losses for these particular businesses. Okay, they were highly complex derivatives trades. Okay, and it sounds a little bit ugly, but they were designed specifically to make sure that their two clients, Procter & Gamble and Gibson greeting cards, could not fully understand them. Okay, they were these two clients, P&G and Gibson greetings, were made to believe that these structures were specifically designed for them, but they were just stock standard structures that they used. And look at this. As part of their normal practice, Bankers Trust is an interesting name for the business. Bankers Trust recorded all of their phone calls, and that the staff could be heard boasting how they managed to fool Procter & Gamble and Gibson greetings with these particular complex structures. The scandal caused them a significant amount of reputational risk that resulted in their CEO resigning, and they were taken to court for this. Okay, we look at some of the lessons learned. Tighter controls are needed. Trades must match the client's needs and expectations and must be fully explained to the clients. Greater caution must be exercised when dealing with client communication. Just be careful, because if you are recording everything, just be very careful what you're saying. And of course, it doesn't allow you to say dishonest things, but just be careful if you are being recorded. Okay, we look over here, the second one, which is Orange County. Okay, Orange County excuse me, made use of repos and had borrowed $12.9 billion in the repo market. Okay, the borrowed funds were used to purchase what we call inverse floating rate notes. Okay, inverse floating means they work in the exact opposite way. Inverse, okay, to the way that a normal interest rate instrument works. The problem was, in 1994, the Federal Reserve increased rates by 250 basis points, which caused a large decline in the value of their portfolios, 1.5 billion in losses. Okay, and of course, what then happened then? Funders stopped rolling over their repos, and as you can see, the same issue coming up, guys, time and time again: funding, liquidity issues. And the last one we're going to look at over here, guys, is Sashin Landesbank. Okay, European banks were one of the largest buyers of US subprime securities prior to the crisis. One of the banks, called Sashin, okay, previously lent to local businesses in Germany. They opened up a unit in Dublin, in Ireland, to be able to invest in this particular. Everybody wanted to jump into this particular market, the US mortgage market. And of course, we know what happened to the US mortgage market in 2007 and 8, the subprime crisis. Okay, and what happened? The value of the investments declined sharply, and they had to be sold to another German state bank. The next major risk, number 7, reputational risk. Okay, reputational risk is the risk of loss of trustworthiness of a firm to meet its financial obligations. Okay, the risk that a firm is perceived as not dealing fairly with their clients, okay, and not conducting business in an ethical manner, and that can in fact lead to the destruction of an entire firm. No great example, the top of page 14, guys. Volkswagen in 2015, the United States Environmental Protection Agency, the EPA, discovered that Volkswagen had in fact been lying on their emissions tests. okay, and that the levels of nitrogen were much, much higher. But what they did is when they were doing their testing, okay, they managed to just to engineer the system to show that they were within an acceptable level. Okay, Volkswagen acknowledged the deception. They put, and that's only after having put 10 million cars onto the road with these false emission controls. The share price fell by over a third, billions of dollars in fines, and their reputation was hit very, very hard. Okay, we look over here at point number 8, corporate governance. Point number 8, corporate governance. Okay, we've dealt quite a lot with corporate governance fails thus far. Okay, we've looked at those London Whale, Volkswagen. Okay, the big one obviously that led to some significant failures was the Enron case. Okay, Enron, being an energy player, often took significant positions in oil futures contracts. And how did their contracts work? They would sell oil for future delivery, receive cash up front. Okay, and they agreed to buy these back at a future date. The truth be told is, if you look at this transaction, what's really happening? They were receiving cash up front and paying it back at a later point. It's called a loan. Okay, why do they not just take out a loan then? Okay, the above mentioned transaction was really a loan, but if you do it this way, for accounting purposes, you don't need to show it as a loan. You don't need to show that you've got excessive leverage. You don't need to show all these kind of things. Typically speaking, with loans, it doesn't look so great sometimes. It made them appear to be in a better financial position than they were. JP Morgan and Citi were the counterparties, and they said no, they had no idea what Enron was getting up to. Okay, and the bank said that in their books it was shown as loans, even though in Enron's books it wasn't shown as loans. And of course, later on, as we know, the scandal, the banks did in fact know what Enron was up to, and they agreed to pay a large fine for that. And one of the interesting things that was introduced, and this might well be your exam question, what act was introduced post the Enron disaster? It was the Sarbanes-Oxley Act of 2002. And the last little one over here, guys, cyber risk. As part of our discussion, we focus on the SWIFT case. Okay, and more, guys, cyber risk is going to become a big discussion, a big thing that we need to focus on. We look at the SWIFT case. SWIFT is a leading system, okay, for the transfer of funds between banks, and is involved in the transfer of billions of dollars daily. The SWIFT system was trusted and reliable. Okay, the problem was hackers used the SWIFT system to steal $81 million from the account of a Bangladeshi bank. Okay, malware was used, okay, that sent unauthorized messages to move the funds, okay, and caused significant losses in this particular case. Okay, and obviously that was the court over here. It was a cyber risk. And obviously, as I said, guys, my sense is that this is going to become much bigger as we move forward. This brings us to the end of this particular topic 9, learning from financial disasters. A vital topic. Please, guys, go through it quite carefully. You will need to know it in a little bit more detail. Okay, you do need to know the specifics of the cases, okay, in order to answer the questions. But once you know the specifics, any question they ask you will be quick and easily answered, and you will score the maximum 3 or 4 marks from this particular topic. Guys, do have a look at the edge checkers. I've given you a couple of questions over there. In total, there's quite a few. Go through those, guys. 13 questions. Please make sure you can do, 15 questions. Please make sure you can do all those questions, and then you've got this section under your belt.